It's a quiet Saturday in mid-February 2026, and while most of the world scrolls through weekend distractions, a single sentence from Moscow's central bank governor just quietly severed one of the last visible threads tying Russia back to the dollar's orbit. Elvira Nabiullina, speaking at a routine press conference on February 13th, delivered words that should have echoed across trading floors from New York to Shanghai. The Central Bank of Russia is not participating in any discussions about returning to dollar-based payments for exports, and in any case, there is no intention to do so. This wasn't fiery rhetoric or last-minute leverage in some backroom negotiation. It was a calm, procedural confirmation of a reality that's been hardening for years. Russia, holding the world's fifth-largest official gold reserves at approximately 2,327 tons, as of the latest quarterly data, the second-largest producer of the metal globally, and now the first major economy to formally incorporate silver into its strategic reserves alongside gold, has crossed a line from which there is no easy retreat. This move isn't about short-term posturing in response to sanctions or diplomatic maneuvering. It's the culmination of a deliberate, multi-year architectural shift away from a dollar-centric system that has defined global finance since the end of the Second World War. And the implications reach far beyond Russia's borders. They touch every savings account denominated in dollars, every portfolio exposed to fiat currencies, and every ounce of gold or silver held as a hedge against uncertainty. When the issuer of the world's reserve currency becomes optional for a major power with vast commodity leverage, the ground beneath the entire monetary landscape begins to shift, and the tremors are already registering in the price of gold, now hovering around $5,040 per ounce, and silver, trading in the mid-$70s with persistent physical premiums signaling deeper stress beneath the surface. To grasp the full weight of Nabiullina's statement, rewind to the shock that set this trajectory in motion. On February 24, 2022, Russia's military operation in Ukraine triggered an unprecedented financial response from the United States and its allies. Within days, nearly $300 billion of Russia's foreign reserves, assets held in dollars, euros, and other Western currencies, were immobilized across jurisdictions from Europe to the United States. This wasn't a targeted freeze on a few accounts. It was the largest seizure of sovereign assets in modern history, executed through the very mechanisms, swift messaging, correspondent banking networks, custodial arrangements that underpin the dollar's global reach. Overnight, the message to every central bank governor became unmistakable. Reserves held in the international financial system are not truly sovereign if geopolitical alignments shift. They are permissions that can be revoked. The freeze extended beyond Russia. It demonstrated the weaponization potential of the dollar system itself. Central banks in emerging markets, many of which had long harbored quiet concerns about over-reliance on any single currency, suddenly faced a stark question: what happens if the same levers are pulled on us? The response wasn't panic selling or dramatic declarations. It was methodical diversification, executed at the sovereign level with time horizons measured in decades rather than quarters. China accelerated its gold acquisitions, extending a buying streak that has now run for multiple consecutive years. India steadily increased its holdings while reducing exposure to dollar-denominated debt. Turkey, Kazakhstan, Poland, and others joined the chorus, adding physical gold at rates unseen in generations. But Russia, under Nabiullina's steady hand, she was named Central Bank Governor of the Year by Euromoney in 2015, and Banker of the Year in 2017, pursued a more aggressive and comprehensive path. Even before the 2022 invasion, Russia had begun shedding dollar assets. By early 2019, it had divested over $100 billion in U.S. treasuries, reallocating into yuan, euros, and notably physical gold. Post-2022, that pivot became irreversible. Russia developed its own system for transfer of financial messages, SPFS, as a swift alternative, deepened integration with China's cross-border interbank payment system, CPS, and shifted the bulk of bilateral trade settlements away from dollars. By late 2025, more than half of China's cross-border transactions with Russia were settled in yuan or rubles, a figure that has continued to climb. India pays for Russian energy in rupees and yuan. Bangladesh has structured payments for major infrastructure projects in yuan. These aren't temporary workarounds. They are operational infrastructure now handling hundreds of billions in annual flows without touching the dollar. The deeper insight often overlooked is that Russia didn't simply replace dollar dependence with yuan dependence. Beijing's tight control over the yuan-ruble exchange rate introduces its own vulnerabilities, including potential capital controls that could trap Russian funds. To mitigate that risk, Russia made a strategic bet on assets that no single government can unilaterally freeze or manipulate: physical gold and, crucially, silver. In a move unprecedented among major central banks in modern times, Russia explicitly incorporated silver into its strategic reserves. This isn't a minor portfolio tweak. It's a recognition that silver carries dual utility, monetary anchor and industrial essential, that gold alone cannot fully replicate. Gold serves as the timeless store of value, the neutral asset that transcends borders and political cycles. Silver, however, embeds itself in the real economy: solar panels, electric vehicles, electronics, medical devices, defense applications. As global electrification accelerates and renewable energy deployment scales, silver demand surges while mining supply struggles to keep pace. By holding both, Russia positions itself with leverage across monetary stability and industrial supply chains, commodities that retain value even when currencies falter. This strategic layering reflects a broader multipolar recalibration. Central banks aren't chasing headlines or short-term hedges. They're executing 30-year plans. Global official sector gold purchases in 2025 totaled 863 tons, a figure that remains historically elevated even as it moderated from the record peaks of prior years. Poland led with substantial additions. China extended its streak. Turkey, Kazakhstan, India, and others contributed steadily. Many analysts suspect China's true holdings exceed official disclosures, potentially approaching or surpassing 5,000 tons. These aren't speculative retail flows. They're sovereign decisions made by entities that issue fiat money, yet choose to accumulate an asset that yields nothing in interest terms. The rationale traces directly to 2022. If reserves can be immobilized by geopolitical decree, then true sovereignty demands assets beyond the reach of any single jurisdiction. Russia's explicit inclusion of silver amplifies this logic. Forecasts for silver in late 2026 point toward $59 per ounce. Driven by industrial momentum and safe haven appeal, though swings of 10% or more remain commonplace. The metal's leverage to gold is well established. In bull cycles, silver tends to outperform on a percentage basis, with the gold-silver ratio compressing from current levels around 65:1 toward historical lows seen in peaks like 2011's 31:1. Should gold climb toward $6,000, $7,000 by 2027-2028, a trajectory some projections support, and the ratio tightens to 51 or below, silver could surpass $120, $140. The geopolitical multiplier is significant. Sanctions persist. Russia requires assets that trade globally without counterparty risk. Gold, commodities essential to adversaries and allies alike. Silver, and energy dominance, oil and gas. This triad forms a negotiating posture rooted in physical control rather than financial intermediation. The U.S. Federal Reserve confronts a parallel trap with fewer escape routes. National debt exceeds $38 trillion as of early 2026, with annual interest payments nearing $1 trillion, surpassing defense outlays. Sustaining rates at current levels crushes fiscal capacity. Aggressive cuts risk reigniting inflation and eroding credibility. Nabiullina's own comments reflect a similar dilemma: readiness to adjust policy if external shocks threaten inflation targets, but with the advantage that Russia no longer shoulders the burden of global reserve status. The Fed must preserve dollar confidence, low inflation, liquid treasury markets, universal acceptance, while foreign demand for U.S. debt softens. Central banks' diversification into gold has reduced foreign ownership of treasuries to around 30% from peaks above 50% during the global financial crisis, a structural erosion, not a cyclical dip. Gold at $5,040 isn't panic pricing. It's rational repricing against a system where trust has fractured. The freezing of Russian assets in 2022 and the weaponization of SWIFT revealed vulnerabilities that cannot be unseen. Once confidence erodes, restoration proves elusive. Russia's declaration isn't novel policy, but explicit acknowledgement of a reality operative since 2022. The dollar system is optional for an expanding bloc. BRICS initiatives, including the 2025 launch of a gold-anchored digital settlement instrument known as the unit, 40% physical gold, 60% national currencies, operationalize alternatives that bypass SWIFT for intra-bloc trade. These aren't theoretical constructs. They facilitate real flows, reducing dollar dependency in practice. Three plausible paths emerge over the next 3 to 5 years. In a baseline scenario, roughly 25% probability, the Fed engineers a soft landing. Inflation stabilizes near 2%. Geopolitical frictions ease. Alternatives remain marginal. Gold consolidates in the $4,500, $5,500 band. Silver drifts. Traditional assets prevail. This requires fiscal restraint and restored faith, possible but strained by current trajectories. The likeliest course, around 50% probability, is gradual multipolarity. Dollar dominance diminishes over a decade or two without collapse. Multiple settlement networks coexist. BRICS centered in Asia, Africa, Latin America, dollar-based in the West. Gold trends towards $6,000, $8,000 by 2028-2030. Silver $80, $120. Central banks diversify steadily. The transition remains manageable. The high-impact tail 25% probability involves accelerated crisis. A geopolitical trigger, fiscal rupture or inflation resurgence shatters confidence. Foreign treasury demand collapses. The Fed's credibility frays. Gold surges beyond $10,000. Silver exceeds $200 amid capital flight into tangibles. This aligns with Russia's preparatory posture, accumulating physicals, building parallel rails. Markets already embed elements of the middle path. Gold at current levels reflects hedging against optional reserve status, not imminent doom. Silver's volatility amplifies the thesis, leveraged exposure to both monetary repricing and industrial scarcity. Russia's silver inclusion underscores the next frontier, commodities with strategic weight in a world where digital claims can vanish overnight. This framework isn't about predicting tomorrow's close, it's about recognizing that the present has shifted. Trust in the dollar system fractured in 2022 and cannot be fully mended. Russia's stance merely vocalizes what actions have already demonstrated. Physical assets endure when paper promises falter. Whether you hold precious metals or not, seeing these currents clearly without hysteria or hype equips you to navigate the decade ahead with eyes wide open. The structural forces driving this evolution are not abstract theories debated in academic halls. They are operational realities reshaping trade flows, reserve compositions, and price discovery in real time. Russia's decision to incorporate silver into strategic reserves marks a pivotal acknowledgement that true sovereignty in a fragmented world requires command over assets immune to unilateral seizure. Gold provides the monetary ballast, universally recognized, historically stable, impossible to fabricate, but silver extends the reach into the productive economy. Its role in photovoltaics, where each solar panel consumes measurable quantities, in electric vehicle batteries and wiring, in 5G infrastructure and advanced electronics, in medical imaging and antimicrobial applications. These are not optional luxuries, but foundational inputs to the energy transition and technological frontier. Global silver demand in recent years has consistently outstripped mine supply, with deficits filled by recycling and drawdowns from existing stocks. Forecasts projecting $59 per ounce by late 2026 reflect a baseline of sustained industrial pull and renewed monetary interest, though the metal's dual identity amplifies volatility. In precious metals bull phases, silver's percentage gains typically exceed gold's, compressing the gold-silver ratio from contemporary levels near 65:1 toward historical compressions seen in prior cycle peaks. Should gold advance to $6,000, $7,000 in the coming years, a trajectory consistent with ongoing central bank accumulation and persistent geopolitical fragmentation, the ratio tightening to 51 or lower could propel silver into triple digits, potentially $120, $140 as industrial users compete with monetary demand. This dynamic carries profound geopolitical weight. Sanctions regimes persist, constraining Russia's access to Western financial rails. In response, Moscow requires a triad of leverage, a monetary asset tradable across borders without intermediary veto, gold, a commodity indispensable to adversaries and partners alike, silver, energy dominance that underpins industrial economies, oil and gas. The combination forms a resilient negotiating posture rooted in physical control rather than financial intermediation. When Nabiullina states that the central bank is not participating in talks on dollar payments and sees no path back, she articulates not a tactical stance but the endpoint of a strategy that has rebuilt payment infrastructure, diversified reserves and secured commodity positions to withstand prolonged isolation. The U.S. confronts a mirror image dilemma with narrower margins for maneuver. Federal debt surpassing $38 trillion in early 2026 translates to interest payments approaching $1 trillion annually, exceeding defense spending and crowding out other priorities. Sustaining policy rates at current levels compounds the burden. Aggressive easing risks reigniting inflation and undermining credibility. Nabiullina herself has signaled readiness to adjust Russia's key rate if external shocks threaten the 4% inflation target in 2026. But Russia operates without the obligation to preserve global reserve status. The Fed must maintain dollar confidence, stable prices, liquid markets, universal acceptance, while foreign appetite for treasuries wanes. Central bank diversification has reduced foreign holdings to around 30% of the market from post-crisis peaks above 50%, a gradual but unrelenting erosion. Gold's perch near $5,040 reflects not speculative froth but a market-based reassessment of fiat vulnerabilities. The 2022 freeze of Russian assets and exclusion from SWIFT exposed the conditional nature of dollar-denominated claims. Trust, once eroded, proves difficult to restore. Russia's declaration merely formalizes what operational shifts have already achieved. The dollar system has become optional for an expanding bloc. BRICS initiatives, including the October 2025 launch of the unit, a gold-anchored digital settlement instrument, 40% physical gold, 60% national currencies, provide functional alternatives that facilitate trade without SWIFT dependency. These mechanisms handle real volumes, reducing dollar necessity in practice and accelerating the multipolar reordering. 3 forward scenarios frame the landscape over the next 3 to 5 years. A baseline case, perhaps 25% probability, envisions the Fed achieving a soft landing, Inflation anchors near 2%. Geopolitical strains moderate. Alternatives remain peripheral. Gold consolidates between $4,500 and $5,500. Silver tracks sideways. Traditional assets dominate. This path demands fiscal discipline and renewed institutional faith, feasible yet challenged by debt dynamics and fragmentation trends. The central tendency, roughly 50% probability, is gradual multipolarity. Dollar primacy diminishes over a decade or two without abrupt collapse. Multiple settlement ecosystems coexist. BRICS led in much of the global south, dollar-based in the west. Gold trends towards $6,000, $8,000 by 2028-2030. Silver $80, $120. Central banks diversify incrementally. The transition unfolds as structural evolution rather than crisis. The tail risk, around 25% probability, involves accelerated fracture, a geopolitical trigger, fiscal impasse, or inflation resurgence shatters confidence. Foreign treasury demand collapses. The Fed's credibility frays. Gold exceeds $10,000. Silver surpasses $200 amid capital flight into tangibles. This aligns with Russia's preparatory actions, physical accumulation, parallel infrastructure, positioning for worst-case contingencies. Markets currently price elements of the middle path. Gold's level embodies hedging against optional reserve status, not imminent catastrophe. Silver's volatility magnifies the exposure, leverage sensitivity to monetary repricing and industrial scarcity. Russia's silver inclusion signals the broadening scope. Commodities with strategic utility gain weight when digital claims prove revocable. This is not about forecasting tomorrow's fix. It's about recognizing that the ground has moved. Trust in the dollar system fractured in 2022 and cannot be fully repaired. Russia's stance vocalizes what actions have demonstrated. Physical assets endure when paper promises falter. Whether you hold precious metals or not, internalizing this framework sharpens perspective on money, savings, and long-term resilience. The people who navigate the decade ahead successfully will be those who see the shift clearly without panic or exaggeration, and position accordingly. The implications cascade beyond the immediate price action into the architecture of global power itself. Russia's explicit inclusion of silver in strategic reserves is not an isolated decision, but part of a calculated layering. Gold is the monetary foundation, silver is the industrial multiplier, energy is the geopolitical fulcrum. In a world where sanctions can immobilize financial assets overnight, control over physical resources confers enduring leverage. Gold trades across borders with minimal friction and retains value through centuries of regime change. Silver embeds in the production chains that power modernity. Photovoltaics converting sunlight to electricity, electric vehicles bridging transport and energy storage, advanced electronics enabling communication and computation. Demand for these applications grows relentlessly, while mine supply faces geological constraints, recycling limitations, and rising extraction costs. The resulting structural deficit, demand consistently exceeding primary production, creates a persistent bid that no paper instrument can fully replicate. Central bank behavior underscores the thesis. Official sector purchases in 2025 reached 863 tons, a figure that, while below the record highs of prior years, remains well above the long-term average and geographically diverse. Poland, China, Turkey, Kazakhstan, India, and others contributed meaningfully, reflecting a shared assessment of risk. China's buying streak has extended across multiple years, with some independent estimates suggesting actual holdings significantly exceed reported levels. These are not speculative positions. They are deliberate allocations by entities that issue fiat currencies yet choose to accumulate non-yielding assets. The motivation traces to the same lesson Russia internalized in 2022. Reserves held in the international financial architecture are vulnerable to political veto. Diversification into gold mitigates that exposure without introducing new dependencies on rival currencies. Silver's dual role amplifies its strategic appeal. As an industrial input, it cannot be substituted in key applications without performance penalties. As a monetary asset, it offers leveraged exposure to gold's trajectory, historically outperforming during bull phases as the gold-silver ratio compresses. Current levels around 65.1 have room to tighten toward previous cycle lows if momentum builds. Professional projections for late 2026 cluster near $59 per ounce, balancing industrial momentum with safe haven characteristics, though the metal's volatility ensures significant swings. In a multipolar transition, silver's scarcity and necessity could accelerate that leverage, particularly if geopolitical fragmentation restricts cross-border flows. The U.S. confronts parallel pressures with fewer degrees of freedom. Debt exceeding $38 trillion translates to interest obligations nearing $1 trillion annually, surpassing defense spending and constraining fiscal maneuverability. Sustaining rates risks compounding the burden. Easing invites inflation resurgence and credibility erosion. Foreign demand for treasuries has softened, with central bank diversification redirecting flows toward gold. The share of foreign ownership has declined to around 30% from post-crisis peaks above 50%, a gradual but persistent structural adjustment. Gold near $5,040 embodies rational repricing against these realities, not speculative excess. The 2022 sanctions demonstrated the conditional nature of dollar claims. Once revealed, that vulnerability cannot be unseen. Russia's declaration formalizes what operational shifts have achieved. The dollar system is optional for an expanding bloc. BRICS mechanisms, including the 2025 introduction of gold-anchored settlement instruments, provide functional pathways that reduce dollar necessity in practice. 3 scenarios map the horizon. A baseline approximately 25% probability envisions Fed's success in stabilizing inflation near 2%, moderating geopolitical strains and containing alternatives. Gold consolidates, traditional assets prevail. This requires discipline and restored confidence, challenging given debt dynamics. The central case, around 50% probability, is gradual multipolarity. Dollar primacy erodes over a decade or two without collapse. Coexisting settlement networks emerge. Gold trends higher, silver follows with leverage. Central banks diversify steadily. The tail scenario, 25% probability, involves accelerated fracture, geopolitical shock, or fiscal crisis shatters confidence. Gold exceeds $10,000. Silver surpasses $200 amid tangible flight. Russia's posture aligns with preparation for this contingency. Markets embed aspects of the middle path. Current levels reflect hedging against optional reserve status. Silver's volatility offers amplified exposure to the thesis, monetary repricing combined with industrial scarcity. This framework transcends short-term trading. It concerns the evolving nature of money itself. Trust in the dollar system fractured in 2022 and cannot be fully restored. Russia's stance articulates what actions have demonstrated. Physical assets endure when paper promises falter. Understanding this shift without hysteria or hype equips clearer thinking about savings, investments, and resilience in an uncertain era. The game has changed. Those who recognize it early navigate it best.